Welcome to Self-Test 1.2 video. In this video, we will look at Lisa Private Limited, who has 4 transactions here for the month of June. And we will see how these 4 transactions affect the accounting equation, which is A stands for assets equals liability plus shareholders' equity. Well, there's no liability in this particular question because none of the transactions here involve liabilities. Since none of them involve liabilities will be 0 and therefore A equals SE. Now, so let's start with the first transaction. We have Lisa. Now, Lisa invests 50,000 cash and in return, so when you invest cash is you know is an asset from the business point of view. So asset will go up, so cash will increase by 50,000. Now, in return, it received already the company issued to Lisa 50,000 ordinary share of $1 each. So 50,000 shares times $1 is worth how much? 50,000. So therefore, this will increase the share capital by 50,000, meaning the amount that the business owes the owner, in this case Lisa, is $50,000. Now going to transaction B. In transaction B, we bought inventory of 10,000 by cash. So since we buy inventory will go up. So look at inventory account and the asset go up means plus, so plus $10,000. But at the same time, we give cash, right? So our cash, which is the asset to the business, will therefore decrease by $10,000. So one asset go up, one asset go down. Net effect of assets is 0, which means our accounting equation remains balanced. Then we come to part C. Now part C and part D is a bit more complex in that it involves two recordings each. So let's begin with transaction C. So for transaction C, firstly we record the first sentence where it says you sold inventory to Mary on credit. So when we sell it at 6,000, this 6,000 is known as the selling price. Okay, because normally we buy low, we sell high, right? So we sell at $6,000. So when we sell, our sales revenue, which is under SE, will increase by 6,000. And when we sell these goods of 6,000 at selling price of $6,000, which increases our sales, did we receive cash in this example? No, right? Because we sold it on credit. On credit means Mary, the customer, will pay us later. But just because we have not received cash doesn't mean this money doesn't belong to us, because it still belongs to us. That's why we open up an account called accounts receivable to capture the amount that is owing to us and that which will eventually come to us in the form of cash, and that will increase by $6,000. Next, we then have to record the cost of inventory sold, which is $2,000. Because when we sold inventory, really our inventory should go down, right? And the amount that goes down in inventory should be the amount that was bought, it should be captured in its original price. So earlier we bought 10,000 worth of goods, we sold 2,000 worth of it, so that's why we decrease it by $2,000, the cost price. But at the same time, we must also capture or record the expenses that goes with it. And the expense account is called cost of sales. So cost of sales will increase by 2,000. So from this transaction, can you see how much profit we made? Well, we sold it for $6,000 when it actually cost us only $2,000. So if we take the revenue here minus the expenses, the profit is $4,000. That's why you see here's negative. But I'll come to that more later. Alright, so I hope that helps you to understand how to record transaction C. Now, shall we move on to the last transaction, which is transaction D, where Mary returned 1,000 inventory due to defects, and the cost of inventory return was $4,000. So when they return the goods that she bought from us at $6,000, naturally the amount that she owes us now will decrease by $1,000, right? Then at the same time, by right, our sales revenue should decrease by $1,000. But instead of recording here as minus 1,000 in the sales revenue column, we want to keep track of the amount of sales return separately. So if that's the case, we open up a dedicated account for it called sales returns. And since 1,000 was returned to us, that sales return account should have increased by $1,000. Okay? So far so good? Alright, if so, let's finally move on. Sorry, that's for the sales, and we have not recorded the cost of sales yet. Now, the cost of sales or cost of inventory that relates to this $1,000 is actually $400. Okay, because remember we bought low, we sell high. So similarly, when they return, we got to adjust both our sales part and our cost of sales portion. So when goods are returned to us, we would now have more inventory, correct? And the inventory that's always recorded here in the inventory account is the cost price. So the cost price is $400, even though we sold it for $1,000. So it's returned to us, our inventory goes up by $400, and at the same time, since we didn't sell that $1,000 that was returned to us, we must also reduce therefore our cost of sales, which is $400. Make sense? So in effect, our cost of sale, if you think about it, it's only 1,600. Finally, once we have recorded all these transactions, we can work out if the accounting equation balances. So beginning with the asset side, again, like the previous self-test 1.1, we calculate the totals of each of the accounts. In this case, there's 3: cash account, the inventory account, and the accounts receivable account. So add them all up, 40,000. Here you add up 8,004. Here you add up 5,000. So add these three up, you'll get 53,400. And for shareholders' equity, here you got to be careful, right? Because you have different types of accounts. So let's look at them one by one. So for ordinary share capital, this is a natural shareholders' equity because this is the amount that we owe the owner. So shareholders' equity will go up by 50,000. And sales, remember, if you read the notes, sales is a revenue. Revenue will always increase profit, and profit in turn will increase shareholders' equity. Because the profit goes back to the owner, and therefore the business now owes the owner, and therefore shareholders' equity will go up. So sales therefore will always increase shareholders' equity. But when it comes to cost of sales and sales return, they, instead of increasing shareholders' equity, will reduce them. Why? Because expenses and sales returns would reduce profit, and therefore in turn will reduce shareholders' equity. That's why it's a negative sign. So please take note, yeah? Expenses and contra revenue, which is basically an account that reduces revenue and therefore in turn reduces profit, would therefore reduce shareholders' equity. That's why you put a negative sign. So please take note. So once you have done that, you add up all these four numbers, it will give you a grand total of 53,400. So does it balance? Yes, it does. Hooray! So please continue to learn and proceed to do self-test 1.3.